Good day, fellow investors. Interesting times are upon us. The markets have really been crashing. And now that we are in a bear market technically, now the question is how much more? Should we buy stocks? Should we sell and wait for better times? A lot of questions arise, and I really want to give you a perspective so that you can understand the framework of long-term investing, how to create wealth over time, even in these turbulent times. When it comes to will stocks crash more, Michael Burry says that the theater took more than a decade to overstuff. Not likely everyone gets out in less than a year. So less than a year people getting out, we are down 23% year to date for the S&P 500. So likely much more room to fall. 5 years, 50% up. So if we just go back to pre-pandemic stability, we are at 2,800. Still one leg down, still 20% down. And that would not be surprising at all, especially with all the things that are going on and that have impacted this. This is an anomaly, you have to understand that. And after an anomaly like this, usually also another anomaly comes in. That's nothing new. The key is that the market has been going up because people were getting in, and now the market is going down because people are getting out. The Nasdaq is a perfect example. So people getting in, fear of missing out, new worlds, tech will change everything, and 84% up in a year and a half. And then, okay, this time isn't different as always, and now we are down 33%. That's completely normal. Most likely the trend will be the trend. That's it. And now when it comes to what will happen next, we have made this video discussing the outlooks, the valuations for the market, where will the S&P 500 be, and stocks in general. I have to tell you, it is impossible to predict. We have the ranges, the outcomes, and then you have to be ready for whatever outcome can be. Because if you're not ready, then you're in trouble. That's it. Nobody knows whether the market will double from today in the next 24 months or will go 50% down. Trust me, nobody knows. You can say something, you can sound smart, but nobody knows. Because what happens to the market depends on the following. Central bank reaction in the short term. The markets follow what the Fed farts. Then we have the economic situation, the earnings in the medium term. So following business developments, valuations, earnings, outlooks, guidances. And then at the bottom of investing, we have business fundamentals long term. Those are the most stable factors to watch. And as I said, everyone is predicting what will happen. And if I just type on YouTube stock market crashes, some people come back from the dead to say that it's going to crash more, worst collapse of our times, the market hasn't bottomed yet. The fact is that nobody knows. Of course, if you look at the trend, this is pretty clear. The trend is negative, so let's just follow the trend. But here everyone was following the trend of 10x stocks, etc. And we'll discuss more about this bubble in the next video tomorrow. And you have to be very careful not to get sucked into these predictions, because where the market goes, it's irrelevant. The market will go up and down, or as JP Morgan always said, the market will fluctuate. That's it. That's all you need to know. If you want to invest, you can take advantage of the market, because by focusing on business fundamentals, you can see when the market is offering you a bargain on those business fundamentals. That is all you need to know when it comes to stock market crashes. And those business fundamentals, yes, are impacted by the economic situation and also by the central bank reaction. You have to see, okay, whatever happens with the Fed, if we have 10% interest rates, how does that impact my business? Does my business survive? If there is inflation, does my business survive? And that's the risk and reward for your business. That's what you have to think about. And on Sunday, we'll again go through 10 stocks and then discuss also what is the outlook for those stocks in whatever environment, to understand the risk and reward and then find the best risks and rewards. But okay, let's discuss central bank actions, because that's always entertaining, but don't forget to have a perspective of investing which is usually detached from the macro. You can look at it, okay, understand it, see how it might impact your business, but let's really check it so that you see how impossible to predict it is. Not even the ECB, not the Fed know what they will be doing a month from now. It's impossible to know. So the Fed, they are committed to cool prices, 0.75 points hike. Of course, that worries a lot of people. Recession odds now hit 72%, and Wall Street is also worried about after the hike. And then if you look at Wall Street projections, Wells Fargo forecasts a mild recession starting in 2022. The Reserve Bank of Atlanta cut estimates for second quarter growth to 0. Guggenheim said US may already be in a recession. But then again, unemployment is historically low, all really well from that perspective, even if that is usually a lagging indicator, but okay. And then again, Bloomberg Economics estimate the downturn to start by 2024 and barely on the radar just a few months ago. And in short, if you look at these predictions and if you listen to CNBC or something, you will see that nobody knows. It's interesting, it's entertaining, it's what you want to know now, here now. It really tickles your short-term mind, so it gives you, it's like Facebook, it's like the Kim Kardashian or whatever people do these days. And that's a problem when it comes to investing, because it shifts your focus away from the right things. And the right things to understand, great example from Ray Dalio, Country Power Index, and it tells you pretty much what are the outcomes when it comes to economies, macro. And then there is for the United States, for China, for other countries. Let's focus just on the top of the summary of the United States. So it's pretty clear. So with the high debt burden and the relatively low expected real growth over the next 10 years, 1.3% per year. That's it. That's the slowest growth over the last few decades. And as he says, the United States is in an unfavorable position in its economic and financial cycles. So debt to GDP is high, foreign debts, okay, it has the dollar which saves it and allows it to do what it does, so that might work for a while. And the big risk is if the US dollar changes its position, that would really weaken the US economically. And the same Eurozone is even worse, as he made a video this morning, so 0.3% per year, really much less power than the United States. And that's it. So sluggish economic growth ahead. There will be ups and downs, there will be recessions, there will be market fluctuations, there will be good times, bad times, there will be news about inflation being lower depending on when the Fed's actions, higher rates, impact the markets. Mortgage rates have boomed. Now, from a leverage perspective, it costs much more, twice more to buy a home than it was the case a few months ago. And that is really remarkable, A, because I told everyone over the last 5 years to take a long-term fixed mortgage, 30 years. I hope you listened. If you didn't listen and you were greedy and took the variable, then you are now in a very tricky place. But that is on you. However, this makes housing more expensive, less housing, less purchases, less investments, lower demand, recession, but also lower inflation. That's how it goes. It will take maybe a month or 2, 3 months to start impacting, but the news likely down the road might be bad until the Fed then changes and says, okay, we don't have to hike, the job is done. That can also be, and then the markets will again go up because of valuations and interest rates stopping at 2, let's say, not 4 like now it's expected. So nobody knows. But then again, the markets are crushed, recession warnings, because nobody knows, and the markets hates uncertainty. Stocks imply 85% of US recession chances. So that's what the market is thinking, but you have to think, okay, how does that impact the businesses I own over the long term, over the short term? Can I add more? How does that impact my job? Will I lose my job or not? If you are at risk of losing your job and you have been investing in tech stocks over the last years, I can't help you. You don't know what you're doing, but you're greedy, and that's it. Greed and fear are the answers. Because I can guarantee you that there will be more recessions. That's a guarantee. When? Nobody knows. I can guarantee you that interest rates will go up and then will go down and up and down. That's a given. When? Nobody knows, not even the Fed. Because it all depends on shocks that are impossible to plan, on actions and reactions that you never know the magnitude. So the Fed hikes, the magnitude of that impact is unknown also for the Fed. They cannot know whether the recession will be terrible, mild, soft landing, hard landing. Impossible to know. They will have to see it later and then again adjust to what they have done. The truth is, as Ray Dalio says, that both Europe, Japan, US are in a pickle because they are getting out of ammunition. If there is a recession, can the Fed lower rates? Can the Fed increase the balance sheet so it's already 8 times up? Can we go to 16 times? Can we lower rates? So we have seen the trend here. It's pretty clear. Lower, lower, and lower. That's the Fed power, and that's why they're running out of ammo. And the long-term debt cycle might end. When? Nobody knows. There will be a lot of volatility. That is what I'm sure of. Ups, positive time, bad times, and then maybe 10 years of average slow economic growth with a few recessions. Can be, anything can happen. As Ray Dalio said, expected real growth over the next 10 years around 1.3%. So we might have 2% for a few years, a recession of 2%, and then again or stability that is impossible to predict. But then again, we have very interesting things starting going around. At any issue, here you have some money. So helicopter money, something that was unprecedented a few years ago, now it's the new normal. Any trouble? Oh, my kid didn't get enough likes on Instagram. Oh, here you have 10,000 bucks. Oh, I don't know, my kid's bike is a little bit old. They bought it just last year. Oh, here is 10,000 for a new bike. If the auto industry gets in trouble, everyone will get a new car. That's how things look like now. So nobody knows where will this go. It will be interesting, definitely much different than what we had over the last 15 years, but don't fall into the mantra of knowing what will happen next. That is what makes things difficult. You then start betting instead of doing whatever happens, I am okay. 6 months ago, taking a 30-year mortgage loan with 2%, whatever happens, you really don't care there. But taking a variable, oh, whatever happens, then you care. That's the mindset that I'm trying to share with these videos. When it comes to investing reality, I do sense fear. Whenever I click here, everyone is very panicking. Of course, they're all selling something, but you have to see whether that fear impacts you, and that is up to you. Because fear is actually great for us investors. It lowers entry prices, and then if there is something that you like and it's lower now, it's a better buy. But then again, I'm sure you're wondering when will stocks rebound, but again, I reiterate myself, it's the wrong focus. You should focus on thinking about being antifragile. Antifragility is a property of systems of people in which they increase in capability to thrive as a result of stressors, shocks, volatility, noise, mistakes, faults, attacks, or failures. So if we call this a shock or something, the key question is, do I take advantage of this? Do I get better from these shocks or not? Because stocks will crash, stocks will rebound. The key is, do you end up better off? If you buy low, sell high, don't do the opposite, then you are an investor and you usually accumulate wealth over these cycles. It's impossible to predict. Whoever predicts is an idiot. We always discuss scenarios here, but I really don't know and actually don't care what happens next. I'm looking at my businesses. I care about those businesses, how those grow, less competition as all these hanky-panky tech businesses crash now, go bust, don't have finances, good businesses will make that jump. Then when it comes to strategy, okay, if this crashes another 70%, how does that impact me? That's the answer you need to have. That's the answer that makes you ready. If this goes 100% up, how does it impact me? That's the answer you need to have. Balance your position so that whatever happens, you're okay. And I'm going to here really close with great quotes from a newsletter that my friend sent. A stock market decline is as routine as a January blizzard in Colorado. If you're from Colorado, let me know if that is correct. If you're prepared, it can't hurt you. A decline is a great opportunity to pick up the bargains left behind by investors who are fleeing the storm in panic. Peter Lynch. After a stock market decline, people may perceive more risk than before when, in fact, lower prices mean less investing risk. The decline may have taken some of the risk out of the market. The job of the Federal Reserve is to take away the punch bowl just as the party gets going. 1970s, but of course the Fed now took away the punch bowl a little bit late likely, but that's a different story. Thanks for watching. I'll see you tomorrow in a new videos discussing these crashes, bubbles, because I really want to give you a great perspective, and Sunday we'll have the 10 stocks weekly analysis.